So let's come to the next one again from completion and review, chapter number 6, as per the study material of the ICAI. Infinity Hospitality Private Limited was established in 1996 and was in the business of running hotels in the tourist destinations in the state of Kerala. It took lease properties on long-term leases ranging from 10 to 12 years, most with a lock-in for a whole term. The terms did not cover the force major clause. The company was family-owned business and had created a good reputation as value for money budget hotel. Most of the time, hotels clock 60 to 75% occupancy rate, and during the festive season vacation, hotel business clocked 100% occupancy. The capital structure of the company was debt-oriented and over-leveraged. Primary working capital was blocked in maintaining and upkeeping the leased properties, running the restaurant, leases, foods and beverages, salary, directors' remuneration, etc. The owners looked at the business as a cash cow and did not plow back the funds to expand the business, but were content with the decent profits the hotels were generating. As the properties were leased and not owned, much of the cash flow generated from operation was used in servicing the property and the huge loan from the financial institution. What was left was withdrawn as the director's remuneration and the dividend. Everything was going on smoothly. However, there were flash floods in Kerala due to unprecedented rains. There were landslides and roads were blocked. The entire tourist season was due to the infrastructural challenges. Accessibility to resorts and hotels was badly hindered. Logistic support took time to reach in the far-flung areas. Visit to the God's own country was last on the mind of the tourists. The company was hardly trying to get back to some semblance of the normalcy when the pandemic struck. It was a double whammy for the company. The impact on travel, tourism, and hospitality business was very severe. The management of Infinity Hospitality Private Limited believed that bad days would end soon and the business would back be to normal. They were also optimistic about the government coming up with the support for the industry and were very hopeful of negotiating with the lessors and the financial institutions for relief. They decided on humanitarian grounds not to terminate the employees and continue paying them a regular salary, maybe deferring 25% to be paid after 1 year. The immediate fallout was on the top line as suddenly the business stopped. The auditors, excises, associates were conducting the audit of the company and were grappling with the situation and are seeking your guidance for the course of action they need to follow. Okay. Right. So again, some theoretical questions and then the MCQ. So first, let us cover the MCQ. Which of the following is not a financial event condition that may cast a significant doubt on the company's ability to continue as a going concern? It is not a financial event or condition. Changes from credit to cash on delivery model with the supplier, it is a financial indication. Arrears or discontinuance of dividend, it is a financial indication. Opening of a new chain of hotel by a renowned competitor near the entity's areas, that's not a financial indication, that's an operating indication. An adverse key financial ratio, again, that's a financial indicator. Right, so which is not a financial event or condition, opening of a new chain of hotels by a renowned competitor near the entity area. Please choose the mitigating measures as the management is unable to pay the lease rental. Cancel the lease, restructure the agreement and negotiate for deferment and relief, terminate the employees and pay the lessor, or all of the above. So what does it say? Better would be not going for an extreme case like cancelling the lease or terminate the employees, restructure the lease agreement and negotiate for the deferment and the relief. Then, which one of the following is not a responsibility of the auditor relating to communicating events or conditions identified that may cast significant doubt on the entity's going concern assertion? Which of the following is not a responsibility of the auditor? Performing additional audit procedures to identify events and conditions beyond 12 months, right? Then after that, probably there is some error in the drafting of the point over there. Right? So let me just come to completion and review, wherein we talk about the subsequent and the going concern and the written representation. Right? So we'll just try to find out that particular case study over here. Right, the MCQ, wherein we'll get to read all of the options over here. Yeah, right, perform additional audit procedures to identify events or conditions beyond 12 months from the balance sheet date, whether the event constitutes a material uncertainty, adequacy of the related disclosures in the financial statements, implication for the audit report. Right, so whether the event constitutes a material uncertainty. right? So whether the events constitute a material uncertainty, right? And then for is the adequacy of the related disclosures in the financial statements. And then the last one is the implication for the audit report. So actually these two put together is the A point, right? Then after that, this is the B point, right? Then this is the C. And then after that, you have the D1, which is the implications for the auditor's report, right? So it's a formatting error over there, right? So the implications for the auditor's report, right? So what does it say? Will you check for events which constitute a material uncertainty? Yes. Will you check for the adequacy of the related disclosures? Yes. Will you check the implications for audit report? Yes. But you check all of this up to 12 months and not beyond the 12 months. So procedure number 1 is not the responsibility of the auditor. Then implication for the audit report, right? What does it say? Written representation to be, oh sorry, this is the formatting error that has been done. Right, so now written representation need to be mandatorily obtained from, right? So again, let us read it from here. Audit committee, client relationship manager, company secretary, CFO of the company, right? So company secretary, so this is A, B, C, and then D is the CFO, right? So now this is our question. So written representation needs to be mandatorily obtained from whom? From the audit committee, client relationship manager, company secretary, or the CFO. So it has to be obtained from a person who is well informed of the matter. So generally it is the CEO, CFO of the company. And the last one, which of the following is not the main pillar of written representation? Right, management responsibility, it is one of the main pillar. Assertion relating to the completeness, relating to provide all information, additional information, and written representation provides sufficient appropriate audit evidence. It gives you the necessary audit evidence, but it does not provide you with the sufficient appropriate audit evidence. So that is not the main pillar of the written representation. Okay, right. So yeah, now let us come to the theory questions over there. Right, so now what additional audit procedures must be undertaken by the auditor as per the requirements of 570 based on the facts given in the case? Right, so now here you have to write down the audit procedures when the events or conditions have been identified. What are the audit procedures? Similar to the audit procedures of the SA 560 regarding the subsequent events, like you need to read the latest. When you read the latest minutes of the meeting, legal counsel, OPS inquiry with the legal counsel, latest interim financial statements, cash flow of the company, audit procedures regarding the subsequent events. Right? Then also after that you have the additional points, like you need to check the existence, terms and adequacy of the borrowing facility, terms of the loan agreement, and also the enforceability of the arrangements to maintain the financial support. And then in addition to that, now the next set of points that they have written over here is the additional audit when there is a significant doubt regarding the entity's ability to continue as a going concern. So if management has not yet done the assessment, requesting the management to do the assessment, then making inquiries regarding the plan of the management based on those plans of the management, asking the management to give you the cash flow forecast and so, then whether any additional facts or information and also the written representation from the management. Right, so they've given both the additional audit procedures. One audit procedure when the event conditions have been identified, and then due to the event condition, if there is a significant doubt regarding the going concern. Then, next question. According to your judgment, what risk assessment procedure should the auditor consider for arriving at a conclusion based on the management assertion of the entity being a going concern? So while performing the risk assessment procedures as per the 315, the auditor will consider whether there are any events or conditions that cast a significant doubt on the entity's ability to continue as a going concern. In doing so, the auditor will first consider whether management has already performed an assessment regarding the going concern. Auditor will discuss the assessment with the management and determine whether the management has identified, again, any events or conditions that may cast a significant doubt. The auditor will draw attention of the management on the following events and conditions and get the response on how they plan to address them. Right, that the company is debt heavy and over leveraged. The leased properties are having considerable lock-in period with the absence of any clause. There is no contingency reserve. All these factors will be taken into account while performing the risk assessment procedure. Okay, right. So that is talking about the risk assessment procedures as per the SA 570 regarding the going concern. Right. So you're going to ask management if they've already performed, discuss with the management, and also the response of the management. Then, what should be the approach of the auditor if the management agrees that a material uncertainty exists, but the entity is a going concern? Is also discuss the reporting requirements. So, what will you do in case of reporting unmodified with the MUGC? Right, unmodified with the MUGC. So, if the auditor concludes that going concern is appropriate, but the material uncertainty exists, one adequately disclose the events or conditions that may cast a significant doubt on the going concern and the management plan to deal with those events and conditions, whether it is adequately disclosed in the financial statement. Then disclose that there is a material uncertainty related to events and conditions because of which the entity may be unable to realize its assets and discharge its liabilities in the normal course of business. The disclosures may include the management's evaluation, significant judgments, and the disclosure about the magnitude of the potential impact. And then auditor, you will express an unmodified with an MUGC. Okay. What if the auditor believes on the basis of the additional audit procedures conducted to conclude that entity is not a going concern, but the management is not accepting the same? So if auditor thinks going concern assumption is inappropriate, adverse opinion. What kind of representation does the auditor need to obtain in case of this scenario? So we want a representation from the management regarding what is their plan and also the feasibility of the plan. Right, regarding the going concern assumption. Okay, right. So that's the theory and the information for the SA 570 in the chapter number 6 regarding the completion and review.